Okay guys, good morning. Looking forward to the week ahead. Final day of July. Before then we get stuck into August, and obviously the first few days of each month typically carries the kind of bulk of the tier 1 important economic data. So I'll review the week ahead towards the end of this briefing, but it's certainly a packed out calendar with plenty of top level economic data globally. We've got Bank of England event, we've got some further US earnings as well as European earnings, the likes of Apple, for example, delivering their Q2 numbers. So plenty to look at. It's definitely, I think, going to be an interesting week. Let's just have a little look first, though, at what's been happening this morning and a very brief look back at Friday. So certainly this morning you've seen some decent, a positive start for global equities. If you just have a look here at the S&P, then we've had a little push to the upside, and we've traded up through the high point that we had. The S&P traded up to 2471 into the close last week. And so if I just take this back slightly to a 60-minute chart, then that was an important price point, because that was the low point we had back on the 26th. We had this step lower here on the 27th, and then on the rebound, around 2471, 2472 has been decent resistance. So that's been broken. We've had a nice sort of breakout up to the next resistance up at R1. Obviously the kind of target on the upside here, when we're looking ahead out over the week in front of us, then the all-time high, which is, well, it's not quite a triple top, but these tops from the 25th, the 26th, and then twice on the 27th, anywhere up around sort of anywhere near 2480 is that kind of barrier that was set last week. That's the all-time high, of course. So, but equities having a decent morning so far. We've had some Chinese data. Let's have a quick catch up on the data that we've already had announced today. So let me just, well, I guess it's the German data. I'm going to show you the calendar here. Sorry, I'm going to show you a chart for German retail sales. So these numbers were delivered at 7 a.m. So 1.1%, this is the month-on-month figure for German retail sales, which was quite a bit better than expected. This is for the month of June, though, so it's a little bit old as we almost start August, but still, we had expected plus 0.2 and it came in at plus 1.1, so significant beat. And as you can see, that's the best monthly print for German retail sales since October, and the second best in the last 12 months. So nice solid reading. And that kind of, I guess, feeds into that interesting price point from Friday morning. If we just have a look at the German inflation chart. So one of the more interesting data points from Friday morning was the German inflation print that came in above expectation. So as you're seeing, inflation measures reverse in other territories like the UK particularly, like also the US, of course. Here in Germany, at least, you're still seeing, well, we've had 2 upticks over the last 2 months. So whilst everyone's going south, German inflation is actually ticking slightly higher, which makes it all the more significant that you're getting that divergence. So these were the, this ties in, I guess, with this kind of strong and resilient German retail consumption data. So this has helped to just, let me go back to, let me just show the China chart also, so before we look back at the chart. So here's, hang on, where is it? Here we go. This is China manufacturing. So we had 51.4. This is for manufacturing PMIs for July. And, well, I don't know. It's kind of mixed here, because that's actually slightly lower than what was expected. We had expected 51.5, came in at 51.4. But as you can see, going back to October, we had this step up, and we've maintained this very consistent run now for, well, almost 9 months straight, where we've had numbers in the region of, in the range between 51.2 and 51.8, and this 51.4 number, is in the middle of that range, so it's fine. The non-manufacturing data from China, also slight miss in terms of expectation, but nice and solid still at 54.5. So this is the data that's really got the session underway. So you've seen equities push higher, certainly US stocks. You can see the DAX here has tried to push, but is finding it a little harder to sustain any upside. And we'll talk, one of the big things I want to talk about today in the briefing is exchange rates, and we're going to look at the euro versus the US dollar in particular. And this is one thing that's really just hurting European equities as we get the euro strengthened to levels we haven't seen for 30 months. So we'll talk about this a little bit later, but just to kind of get things going, we've got equities on the upside. You've got so a little bit of a risk-off theme because you've got gold pushing lower, trading down to test the pivot level here, having had a very strong week last week. So gold under a little bit of pressure. Oil's kind of flat at this point. Bond markets, well, if you have a look at T-notes, then again, nice step higher at the end of last week, and we've been kind of sideways and a slight dip this morning. So as equities have gone up, you've got bonds just edging a tad lower. You've got gold coming off to test its pivot level. So a very mild risk-on theme to kind of get the week underway. But let's just have a look back, because what I want to talk about mainly, and I'm going to bring up my euro-dollar chart here, and we're just going to look at this on a slightly longer time period. So we go to a daily chart. Just going to get rid of the pivots. Go to a daily chart here. This has been quite a phenomenal run for this exchange rate. If you go back to those lows we had back at the end of last year, where we traded right the way down to below 104, and since then this rise has been pretty sensational. So we want to talk about this. We've got a few graphics and stuff. Why is it happening, and what does it mean? Here's a chart to look at. This is it's got to be one of the most interesting charts, comparative charts out there at the moment. This is looking at the S&P 500, and it's looking at the dollar, and looking back to the election and sort of almost kind of rebasing them back at the election here, where DJT pulled off the unthinkable and won the White House. And so it's certainly very positively correlated reaction to both of these markets as you trade into year end. And obviously this was off the back of the idea that the Republican Congress and the Republican White House could deliver on Trump's pretty radical tax cuts. Okay, so you had a strong push to the upside, equities rallying off the promise of a 15% corporate tax rate, and then the idea being this would foster some, an acceleration in US growth, which would lead to an acceleration in inflation, which would lead therefore to the Federal Reserve, stepping up their rate hiking trajectory. Okay, so the hawkish outlook driving that dollar higher as well. Then we hit the start of the year, and what happened at the start of the year? Well, Trump made a comment, and he said this strong dollar's hurting us. The strength of the dollar here is really having a negative effect on our exporters. And he said that, really this is a reflection in people's confidence in me. So that's what he said at the start of the year. The dollar's really strong because of people's confidence in me. What I'd like to hear him say now, which he's never going to say in 100 million years, but I'd like, if you fast forward 7 months, and here the dollar's trading down at levels we haven't seen for a couple of years, I would like him to now say the dollar's too weak because people have lost confidence in me. That's what I'd like him to say. That's really the reality of it, except obviously he's never going to admit to anything of that kind of nature. But you've got a quite unbelievable divergence here, but this divergence isn't stopping. People are looking at this and going, wow, what the hell, that's not sustainable. But it's been sustainable for 7 months, so what's to say it's not going to carry on widening? It certainly feels like that at the moment. This equity push to the upside almost feels unstoppable. And as it stands, this dollar move, and this is the dollar index measured on the right-hand side of this chart, So this is the dollar measured against a basket of currencies, but it's pretty much the euro makes up about 60% of that basket. And then you've got the pound in there as well, of course. Both of those currencies particularly have appreciated. But look, this is, why is this happening? Why is the dollar weakening and why is the S&P not? And obviously, if you go back and have a look at the data that we had on Friday and you check out the GDP figures for the month of, for the quarter, for quarter two, then, this was slightly weaker than expected. This 2.6% print here was weaker than expected. They also downgraded quarter one growth. It was 1.4% and it got chopped to 1.2. I mean, on this chart, it doesn't look like there's any kind of emergency here. This growth looks pretty similar to what it's been like in the last few years, barring that 5.2 giant print back here that you can see on the left-hand side of that chart. Apart from that big number, this looks pretty much more of the same, and that is true. It's just that it's more of the same, and the same being well below average growth. The US, if you took the 40 years before the financial crisis, grew on average of just over 3% a year, and we've only had one quarter where that's happened in the last 2.5 years, never mind a whole year's worth of growth above 3%. We've actually only had one quarter. And we've had some phenomenally low ball prints along the way as well, especially end of 2015, start of 2016. But the GDP figure on Friday was a disappointment. And it just reflects this general trend we've had where we've seen a deterioration in US data. And certainly the inflation, and if we just have a very quick look at the inflation data in particular, this has been ticking lower for 5 months straight now, and back to 1.6%. And of course, this has translated through to then the Federal Reserve last week via their statement, just turning a touch more dovish. And as we kind of get properly into the second half of 2017, it looks like things are softening up, and we're now questioning whether the Fed are going to hike again this year. Obviously, the current forecast and the current expectations are the Fed use their September meeting to start tapering their asset repurchase program. This is the reinvestment program. So this is where they're reinvesting proceeds that are coming in from redemption payments from assets that they own, and so they're going to start tapering that. That's tightening. And then the thought process was we'd hit December and they'd hike rates, but people are questioning that now, given what's happened with the data. And so you got this dollar weakness. The other big part of that story, why else is the dollar weakening? Well, yeah, it's Trump, isn't it? So let me get back to that chart. Well, no, I'll show you this one whilst I'm talking about it. It's Trump. If the dollar rallied end of last year off the idea Trump would deliver on tax cuts, he would drive an acceleration in growth, we'd get the Fed having to ramp up their hawkishness. Well, all that's kind of unwinding. And so, these are the big two themes, and obviously the failure of the very slimmed down repeal of Obamacare bill, the failure of that in the Senate last week with McCain stabbing Trump in the back. Obviously, this just shows that Trump has met his match in terms of Congress blocking what he wants to do. So, these are all the themes that play into this dollar weakness. So, how is this having an effect elsewhere? Because let's have a quick look around some of these other charts. Obviously, well, let's just stay here with the euro-dollar chart, because this is, and I'm going to go to a weekly time period here, because these are levels we haven't seen for a very long time indeed. I mean, even a weekly chart here doesn't get us back to. Here's the chart we want to look at. So right up here at 118. So last week we hit a high 118.08. Last time we traded 118 was January 2015. The point is the speed of this appreciation is something else to really be take note of. We've gone from 105 to 118 in the space of 3 months. That is a rapid change. A change of that magnitude. That's high speed. And so, when you're looking at the DAX, even just this morning, you're looking at the DAX, and as US equities stride up through the highs, the DAX really struggling to do so. And as US equities make all-time highs again last week, the DAX had a down week. So you're definitely seeing this currency and this exchange rate differential really start to drive now a divergence in the equity space as well. And this is something you've got to be mindful of this week, as I hope you were last week and indeed the week before. Don't think US equities gunning to new highs yet again. Don't think that's a license to just buy Europe. This euro appreciation is definitely having an impact. If we have a look at the pound versus the dollar, and you can check out the FTSE 100, which is similar to the DAX in that the FTSE had a down week last week, and the FTSE, I guess it's closer to its high than the DAX is, but still. This is the value of the pound versus the dollar, and last week we traded up to we're almost at 132, and you can see the last time we were there was September. But I guess the thing about the pound here is obviously Brexit is the major force here if you look back over the last 12 months, and the euro doesn't have that Brexit weakening element like the pound does. But still, this is certainly moves back to levels we haven't seen for many, many months. On the Brexit front, we really should see things quieten down now as everyone kind of breaks for August. And actually the next scheduled round of talks now isn't until the end of August. So we may well get a lack of development on the Brexit issue. We've got the Bank of England, just whilst we're here looking at cable, we've got the Bank of England policy meeting this Thursday. We're expecting to see the vote, because last month's vote was very surprising. We had a vote where the vote split was 5-3, so 5 members of the Monetary Policy Committee voted to leave rates unchanged at 0.25%, sorry, and 3 members voted to hike, and this was a big surprise. We weren't expecting 3 members to vote for a hike. It was a very hawkish meeting, but that was last month. This is this month. We're going to see, certainly we had inflation drop for the first time in many months for July, and so that might just give the Bank of England a bit of a breather. We've got Forbes has stepped out of the committee now, so she's gone, and she was one of the hawks. So we're expecting the vote split to drop back to 6-2. 6 to leave rates unchanged and 2 to hike. So we'll keep an eye out for that. But certainly the Bank of England hawkishness is definitely one of the factors that's led to cable rising. The ECB hawkishness, you can still see my Eurodollar chart, top left, the ECB hawkishness has been a big feature of the euro rising as well. Just as the Fed turned dovish, the ECB and the Bank of England have turned hawkish, and so you're getting this monetary policy divergence. Have a pretty dramatic effect on exchange rates, to the point where it's now starting to have an impact on equities. So let's have a look at commodities then. Certainly gold has been, if we go to a daily chart here, gold has been loving it over the last few weeks. Huge reversal and rebound off that near test of $1,200 back at the 10th of July. So again, the speed of change here is the most amazing thing, and this has been a feature of the year for gold. It's been a real yo-yo seesaw year. Let me just get rid of these pivot levels, tidy this up a little bit. One sec. Here we go. So obviously we've got this key double top just shy of $1,300. We got a big barrier down here at $1,200, and we've been up and down and up and down and up and down, and it should be no surprise we're back up. It's just the speed of this each time though is fairly phenomenal. So obviously with the dollar weakening, and let me just show you that chart, that long-term chart, or this is just a chart of this year, I should say. This is the dollar index in free fall here almost. So as the dollar weakens, this is good news for commodities, right? So commodity prices have benefited. This is across the piece. Certainly gold here, but iron ore prices, crude oil we'll have a look at in a minute. You've got commodity markets generally benefiting from this persistent dollar weakness. And so for gold, we'll see. I mean, obviously for gold, it's also a safe haven. But when you've got equities trading at all-time highs, you can't really say there's any safe haven flow here, or is there? There might be. There might just be safe haven flow in gold, and equity traders have just got a different opinion. But for now, we're tracking higher, back up into the upper half of this kind of range that we've seen for 2017. Let's have a look at oil then. One of the more interesting moves, one of the more interesting markets. Let's go to a daily chart here as well, and let me just tidy this up. So, certainly a big week for crude oil last week. Push up through 47 bucks, then the key break of the high from the week before, 47.55, and just launched. Monday's session saw almost a $2.50 range, low to high, as Saudi kind of threatened that they were looking at cutting production further. We then traded positively through the week. Obviously, the weakening dollar certainly helped. On top of that, if I show you the US crude oil production chart, this is a very long-term chart. But if I show you, zoom in on last week, well, then US crude oil production levels dropped back to 9.41 million. This is off that high point we had back here earlier in the month. So crude oil production dropping, and this morning we've had a test of 50 bucks. So today's high, 50.06. So look, you've got dollar weakness, you've got crude oil production dropping, you've got Saudi Arabia saying, look, we're really keen to maybe cut production further. And then the fourth element of this is a more subtle one, and that is actually that certainly on Brent crude in the front 2 months, you've actually had a swing to backwardation. You've had crude oil prices in contango for a long time now, which is a reflection of a large amount of short-term supply. So an excess amount of short-term supply drives contango, and maybe for the first time in ages and months and like a couple of years, if not more, you had Brent crude swing back into backwardation, which is an indication perhaps of a lack of short-term supply. So when you're trying to think about this huge amount of excess surplus of supply, this glut of supply that's driven prices down to below $40. When you're looking at any kind of signals for that glut of excess supply to be finally reducing, well, Brent crude right at the front end of the curve moving into backwardation is quite an interesting development, and so that certainly helped as well. So incredibly bullish week for crude oil last week. Can it go higher? Obviously the speed of change here again is just phenomenal. Can it move higher? Now that we hit $50, obviously this is important. We've hit it today, and it's really interesting to see how today pans out. Obviously it can go higher and has done in recent times. Go back to May, we topped out at 52 bucks, and indeed $52 is an important kind of price point. The high of the year was set back in April, and that was up at 53.76. So obviously we can go higher, but $50 here is a key barrier. After what's been a huge move, we've had a 10% move. Since the end of last week, well, not last week, the end of the week before, the 24th of July. The 24th of July. Sorry, that was last week. The start of last week to the start of this week, 10%. That's a rate of change that you would have thought is not sustainable, but we shall see. So certainly some interesting stuff going on across markets, and I'd say the dollar weakness is the one key market that's grabbing the headlines. You've got some other weird stuff happening. Look, check out this chart. So some other kind of side effects of this dollar weakness. This is the Hong Kong overnight lending cost. So the Hong Kong interbank offer rate. So I'm sure you've heard of LIBOR, which is the London interbank offer rate, which is that overnight banking rate that is the kind of reference point for a couple of $1 trillion worth of loans and credit facilities globally. Well, this is HIBOR, Hong Kong interbank offer rate, and check this out, big spike overnight. And so this is very short-term lending rates, and this has spiked to levels we haven't seen since 2008. So the cost of overnight lending in the interbank market over in Hong Kong, and this is being attributed to a 2-year low against the US dollar. So as the dollar makes dramatic moves, well, don't forget you've got a huge number of currencies that are pegged to the dollar, and obviously this is, hurting anybody that's producing commodities. Not that obviously Hong Kong does, but you're getting side effects elsewhere, each in their own right, are kind of quite alarming in the short term. So the dollar weakness is going to be the thing to watch, I would say, this week. So keep your eye on that. Obviously, euro dollar up at 118, cable just shy of 132. These are levels that we haven't seen for a long time. And so I'd say the dollar might lead things this week. All right, let's have a look at what's happening this week. As I said at the start of this briefing, lots going on. I'm going to show you the weekly calendar to start with here. So we've had the Chinese data and the German data. Next up this morning is at 10, so in an hour's time, and we're going to get European... I'll come back to today in more detail, actually, when we look at today's calendar. But we've got unemployment numbers out of Europe. This afternoon, we've got pending home sales, and we've got Dallas Fed manufacturing. So I'd say this is the final day of July, of course. So this is probably today and Wednesday are the least interesting days of the week. Tomorrow, packed calendar, first day of the month, always global manufacturing day. We've had a sneak preview from China this morning, but we'll get there more sort of smaller cap, privately owned manufacturing PMI index report overnight tonight. We've got an interest rate decision from Australia. We've got the European heavyweights, so France and Germany coming in with their manufacturing PMIs tomorrow morning. Along with the UK, we've got EU GDP final print. This is for Q2. Then we've got US ISM manufacturing data as the pick of the bunch, as well as some inflationary numbers as well, of course, which are hugely important when we continue to think about this conundrum that the Fed face. Can they hike again this year? We've got API oil inventory numbers Tuesday night. Tracking through Wednesday, we've got UK construction PMIs, a quite quiet Wednesday morning, but then we've got ADP employment numbers from the US, and then definitely important, the Department of Energy numbers. Can oil continue to track higher? Can it break $50 this week? We get the Fed's Mester talking as well on Wednesday. Into Thursday, and then this is services PMI day. So all of Europe, or the European heavyweights, delivering their services PMI numbers. Along with the UK. Then it's the Bank of England interest rate decision. Will they drop to 6.2 on the rate count vote count? We've got the ISM non-manufacturing data, Mark Carney press conference. So big day Thursday, and then Friday very quiet in the morning. In fact, no European data at all. But hopefully that'll be made up for the fact that it's non-farm payrolls day. So we've got the US employment report. Look down here at the bottom. It is still earnings season. And we've got the biggest gun of all of them with Apple reporting this week. We've also got Pfizer, the biggest healthcare stock. We've got Tesla. We've got Berkshire Hathaway. Interesting mix of companies here reporting this week. And then over here in Europe, some big guns. HSBC talking up a 2 billion share buyback program this morning. Heineken, BP, ING Group, Siemens, BMW, Swiss Re. So again, an interesting mix of sectors, all heavyweight companies reporting. So quite, definitely an action-packed week. Let's have a look at today in more detail. So as I said, next up is this European data. We've got inflation figures. These are year-on-year inflation figure. What is that? It doesn't say if it's CPI or not. We'll have a look, but nearer the time. But we've got inflation figures from Europe. We've also got the unemployment rate. I had a graphic from the FT on the European unemployment rate. Here it is, just to show that everyone's obviously bullish Europe. That's been the theme of 2017. That's been the real standout positive surprise. It's been European economic momentum, even to the point where the ECB can start to be hawkish. Who would have thought? So, however, there is an underlying problem under the bonnet, and this is still a huge amount of slack in the European workforce. And some of these numbers are just quite breathtaking. But if you take the unemployment rate only, then obviously Greece and Spain are your big outliers. Greek unemployment, official unemployment, up above 20% still. Spain still in the high teens. When you add in the quota inactive but wants to work, well then Italy steps up to join those three in a group of countries where the unemployment situation is still absolutely desperate. Obviously middle Europe is much better off, but even, I don't know, take France, you've got unemployment at 10%. Portugal, unemployment 10%. This is not good. Obviously Germany's the standout positive amongst the whole group, but when you're looking at Europe as a whole, so you can see the EU here in the middle. When you add on all these other parts, the inactive, wants work, involuntary, part-time, then this takes the EU figure almost to 20%. So a huge amount of slack in the European workforce, and you've seen this slack, this very slack tightening in other developed markets like the US and like the UK, but Europe's certainly a long way behind here in the recovery of the labour market. So we'll get an update on this at 10 o'clock. Just finishing with a final look at what's happening this afternoon on the calendar. It's definitely a quiet one for the US today. We've got Chicago PMI data, probably the most interesting. We've got pending home sales as well, but these are minor data points compared to what's coming further, later in the week with ISM manufacturing tomorrow, for example. Okay, final quick look back at the charts then, and let's zoom back into what's gone on this morning. So as I said, mild risk on start to the day. We've had equities pushing higher. We've had the dollar trying to regain some strength. So the dollar's been strong, which is just more about reversing some of last week's weakness, obviously. So the dollar's had a go at trying to be strong. Equities have been very positive. Bonds have ticked slightly lower, but don't seem too interested in extending that. Gold's pulled off from its highs and oil's hit $50. So that's summing up what's gone on so far today. Later on this morning, I want to talk about yield differential, and again, just expand out on this dollar weakness theme, because one of the things, and we'll talk about the carry trade, because one of the things that should support the dollar strength is the fact that when you're looking at two-year yields, the yield of a US two-year relative to, let's say, Germany are still at multi-decade highs. So that's US yields higher than Europe's, which should attract money into the US, which should be a dollar strengthening scenario, but isn't. The dollar's weakened all year against the euro, so it's a bit of an anomaly. So we'll talk a bit more about that. All right, that's it for now, guys, from me. Back to concentrating on your trades. Next data up at 10 a.m. Thanks a lot.